Welcome to Bloomberg Technology. I'm Emily Chang, currently sheltering in place in San Francisco. Stocks tumbling today. This after Dr. Anthony Fauci warned that reopening the economy too soon could backfire. Dr. Fauci telling a Senate hearing that there are several COVID-19 vaccines in development, but he expects none of them to be ready by the fall. This as the Chinese city of Wuhan, the original epicenter of the pandemic, is seeing a resurgence in infections. The city will now test its entire population of 11 million people. Meantime, back here in the United States, Fed officials warning that widespread bankruptcies could plunge the U.S. into another depression. I want to bring in Bloomberg's markets reporter, Taylor Riggs, who's been following all of this. And Taylor, markets going into the red, another raft of bad economic data. We saw record deflation. Why are the markets only reacting to this now?
Yeah, finally one of the first few days where we had poor economic data and then poor stock market reaction. Usually we haven't been seeing that as the markets have been more forward looking. I think the data and the virus conversations that you just mentioned all sort of played a role here. Deflation, as you can see, CPI on a core basis fell about 0.4% month over month. Year over year was also less than expected. I do keep hearing, though, that today's deflation is tomorrow's inflation. That's according to BlackRock's Rick Reeder, that when demand comes back online, you do have some inflationary forces in place, namely that of the fiscal and monetary policies that we keep enacting. And that's what I wanted to really focus on, some of the monetary policies that are going on, because part of the rotation that you saw today out of equities into bonds, you can thank the Fed for that. Today, the Fed, for the first time, said and actually started acting on it, buying bonds, buying bond-backed ETFs, and buying those so-called fallen angels, or bonds that have been most recently downgraded into the junk territory. So if you believe that you should buy what the Fed is buying, that was part of the rotation today out of equities over into the bond market.
Big tech fell for the first time in 7 days, but it's still an outperformer. I wonder, are investors looking at tech as kind of a safe haven?
I keep hearing that. The tech really has become the new defensive sector here. You take a look at the companies with great free cash flow, strong balance sheets, expanding operating margins. Those are all most of the companies in the tech sector, namely the big tech. If you take a look at the Nasdaq 100 or the big tech really there, today, of course, was the exception, but coming into this in 6 of the last 7 days, you did have the Nasdaq 100 really gaining. FANG today outperformed even though it was lower. So I do keep hearing that tech is providing a little bit of a defensive position here when it comes to the health of the balance sheet. Apple is also another company that was really leading today. Again, today was a different story, but in the last 6 of the 7 days, Apple has gained more than 1% in every day. You had a price target raise here by Wedbush, raising that now to $350 a share, saying that the iPhone 12 should start the road to recovery, and that he's really confident that the storm, the eye of the storm, is now in the rear view mirror, at least from both a demand and a supply chain perspective. So in that case, you're actually seeing Apple, some of the FANGs, some of the other big tech stocks really leading on a lot of that hope and optimism.
Meantime, Taylor, big news potentially in the food delivery space. Our own Ed Hammond reporting that Uber has made an offer to buy Grubhub. Obviously, Grubhub, we saw shares there surging almost 30%. Uber shares ending the day up. But of course, this is a largely still unprofitable business, and I wonder how this benefits the both of them.
Yeah, so we knew that the food delivery space, Emily, is cash intensive and it's very competitive. And I know that you'll be speaking to an analyst after this who can give you more perspective on that. But let me just give you the basics here. Uber Eats, as we know, was the savior for Uber's quarter last year when they just reported, given that they saw ride sharing drop for one of the first times ever. Uber Eats bookings growth there was able to grow 50% last quarter. So that Eats business is providing a little bit of a safe haven there for that company. As we know, it is also a very competitive space, and we were looking for some consolidation. We've been hearing some rumors of consolidation among all of the big players for some time now. This could be the beginning of that. Again, competitive, highly cash intensive. You wonder if this deal would go through, and that could be a big if this is starting to turn around some of that cash intensive business into potentially being one of the profitable ones.
All right, Bloomberg's Taylor Riggs, thanks so much. As you mentioned, I want to bring in Tom White, D.A. Davidson analyst, Tom, who covers this space. What's your take on this, Tom, especially given that all of these businesses have struggled to make money? They are low margin right now. Yes, they are seeing a surge in demand, but does this really make business sense for Grubhub and Uber?
Yeah. Hi. First off, thanks for having me. And look, echoing comments from Taylor there, we've long held that consolidation in this space was going to be inevitable. You've got a lot of companies with effectively identical business models who are really kind of bashing each other's brains out in a fight for market share, and that's pressuring unit economics. It's pressuring profitability. I would push back on the notion that online food delivery can't be a very profitable business eventually. It is a two-sided marketplace, or in some cases a three-sided marketplace model. Not a ton of kind of capex intensity, capital intensity. So generally, we think the business model is sound. And I think what you're seeing here from Uber's rationale is that this pandemic is probably permanently expanding the size of the online food delivery market. At a minimum, it's pulling forward a lot of future demand for online food delivery that was inevitably probably going to take place over the coming years, and it's pulling it forward to the present. And we think Uber's kind of making the call that a lot of that demand pull forward is probably permanent. And so this is a good time to try and potentially consummate a deal for Grubhub. But I think there's some interesting sort of wrinkles or complexities that are posed by the timing of this as well.
Interesting. Certainly, I can understand the idea that the pandemic may form some new habits, but you have to imagine that when it's not so terrifying to just go to the grocery store, that people will want to get out of the house and won't want to order in.
Yep, certainly. I would agree with that. I certainly look forward to doing that myself. But I think there are swaths of the population who probably hadn't experimented with online food delivery in the past. Potentially older segments of the population, other demographics like that, that will probably still use the services now that they've sort of relied on them so much during the pandemic. So I think that idea of category expansion probably is a big motivator for Uber to try and make the move now, but it also might be a motivator for Grubhub to kind of hold out for potentially a richer valuation, or potentially hold out to try and remain independent here.
Grubhub did say in a statement that consolidation would make sense in our industry, and like any responsible company, we are always looking at value-enhancing opportunities, but didn't confirm Uber's overture directly. What's the likelihood, you think, of this deal going through? I mean, are there really other suitors out there that would make a buy like this right here, right now?
Yeah, I wish I had a crystal ball. I think Grubhub stock sold off a little bit after that statement. But, my personal interpretation of Grubhub's statement was that, it really wasn't a denial one way or the other. It was sort of, I think kept things very open-ended. So I think there's still a decent possibility that the two parties come to some sort of agreement. In terms of other suitors, hard to say. One thing I will say is that when you see a category or a segment of the economy kind of experience this sort of stair-step function expansion like we're seeing with food delivery as a result of the pandemic, it tends to attract capital. And so it's not inconceivable that you could, potentially see other suitors or other companies, trying to inject capital in this space, either via investments or other types of mergers. But, it's tough to say.
All right, Tom White of D.A. Davidson, thanks so much for stopping by and sharing your perspective with us. Of course, we'll continue to follow whether or not a deal happens there. Coming up, the work-from-home boom is boosting business at tech companies, including Dropbox. We'll speak with CEO Drew Houston coming up. This is Bloomberg. After years of working to cut costs and add paying customers, Dropbox is seeing a positive return. The work-sharing file storage company reporting its first positive net income ever. This as a surge in business comes with so many companies and employees working remotely. Earlier today, I spoke with Dropbox CEO Drew Houston.
We had a strong Q1 and an important milestone around reaching GAAP profitability, and we've been laying the tracks for a while for that. And we've always been focused on building healthy fundamentals, and so it's nice to see that reflected in the numbers. And then recently, we've seen record demand for Dropbox as our customers have been forced to distributed work in the most dramatic possible imaginable way. But we're seeing record trial volumes of people trying Dropbox Business. It's up about 40%. Engagement on our new desktop app is up 60%. And so, but we're fortunate that it's been really rewarding to see our customers turn to Dropbox in that transition to remote work, and whether it's been a hospital in Boston using Dropbox to coordinate its response, or lenders using HelloSign to help small businesses with their loan relief applications.
Now, are you concerned that when we return to some sort of new normal, that all of this new business or some of this new business goes away?
We're headed into a pretty unpredictable macro environment. And so there's so many people struggling. And when our customers are struggling economically, that impacts our business, that impacts every business. And so we're keeping an eye on these trends, of course. But I think more broadly, there can be a silver lining in all this. And even after we go back to the office, we're going to have more flexibility. And I think this shift to distributed work is going to last well beyond when we're physically back. And there can be a lot of good things from that. So if you're able to work from home and be equally productive, and if you've got a long commute, being able to work from home for a day or two a week, even if you primarily go to the office, can be a good thing. But we see this as there's certainly record demand for tools that make that experience good. We expect that to continue long after we go back.
Now, what about the economic devastation? And you obviously have customers, I'm sure, that are hurting here. What's the risk that they cut off their subscriptions? And are you doing anything to help the customers who are kind of desperate right now?
The human toll of COVID has been unbelievable, and just with so many lives turned upside down. And we know that a lot of our customers are deeply impacted too. And so our first focus is just helping our customers manage the transition. And certainly for the customers that are really in need, we're helping them with more flexible payment terms, or making things work for them. I think in general, our customers are knowledge workers, and so often they are able to work from home, so they're relatively less impacted than some other sectors. And every business needs to collaborate around content, and that's especially true when you're in a distributed environment or you're working from home. So we see Dropbox tends to be essential to business operations. But yeah, it's too early to tell what the overall impact will be on our business.
Now, there'd been a lot of talk about a V-shaped recovery, but it's looking more like it's going to be some sort of abnormal recovery, if there is a recovery in fits and starts. I mean, what are you modeling out about what this means for your customers and your business?
We're watching the trends closely, and you extrapolate what you can, but I think as you said, no one really knows how this is all going to evolve. And so what we do is we plan for a variety of different scenarios, as most companies do. But we're focused on really just making sure that we have a healthy business and healthy fundamentals. And so milestones like GAAP profitability are important to us, having a strong balance sheet, but continue to run the business and take advantage of the opportunities this presents to really make distributed work a great experience.
So do you see being able to maintain profitability through the end of the year, through the next several quarters? I mean, is that something that is going to be your new normal?
We have stated that as our goal for the year, yes.
So pre-COVID, Dropbox sponsored a live hacking competition, and some of the participants discovered a vulnerability in Zoom. Obviously, Zoom has been widely used throughout the pandemic, and I know Dropbox has an integration with Zoom. How closely are you tracking Zoom security issues now, and do you feel like it's a safe platform?
Well, Zoom, first, security is our top priority, and it's the first thing that we think about. It's the first thing our customers think about. We make a number of investments there, and one thing we do is, we do a variety of different things to ensure the security of our platform, both our first-party tools and our integrations. And Zoom, we know security is top of mind for them too. They've been a great partner. And we feel good about the safety of our integration with them. It's very popular. It's a critical tool. We use it at Dropbox. And so we know that they're making the right investments in this area.
We talked about how some work from home trends survive, and I'm sure you're thinking about how does this impact your own workforce. You said you're still hiring, but slowly. I mean, if the economy keeps getting worse, do you see potentially layoffs or a hiring freeze? And how are you navigating the kind of people issues?
Sure. Well, as you mentioned, we've slowed hiring, and mainly because we're headed into an unpredictable environment. But we're continuing to run the business. We're continuing to hire for a number of roles. Unfortunately, we're less impacted than a lot of companies, and so we don't have any plans to do anything dramatic or do layoffs right now. But we're all watching the situation closely, and want to be prudent. So we've slowed down our rate of hiring for the time being.
Now, there's also some new opportunities that remote work opens up, and that, you know, maybe it doesn't matter where your employees live. And I'm curious how this is changing your thinking and perhaps giving you more flexibility or sparking new ideas for how you can run the company different as we come out of it.
I think one thing we're learning from this experience is there's a lot of room for improvement, and you lose a lot by not being in the office. And things that are really easy when your team's in the same room together, like figure out how everyone's doing, what happened on your team today, become pretty difficult when you're working from home, because what do you have to do? You have to like read all these emails and chat transcripts, and so there's a lot of manual labor to do some of the most basic things. And so that's certainly been top of mind for us, and we've been reorienting our roadmap actually to around teams and distributed work. And so how do you recreate that experience of being in the same room together? We're focused on, all right, well, this all just happened to us in the most dramatic way possible, but what if we design this work from home experience to be really great? And that's the opportunity we see through this.
Drew Houston, CEO of Dropbox there. Coming up, state lawmakers want answers from Amazon, but Amazon isn't giving them the answers they want. We will discuss next. This is Bloomberg.
You don't know, or you're just not going to tell us how many cases have been discovered?
I don't. I mean, we know. I don't have the number right on me at this moment because it's not a particularly useful number.
Refusals like the one you just saw by Amazon's global logistics chief, Dave Clark, in an interview with CBS's 60 Minutes, has attorneys general in 12 states and Washington, D.C. demanding more answers. They are calling on Amazon to release a state-by-state breakdown of how many of its workers have been infected with and died from COVID-19. I want to bring in Bloomberg Spencer Soper, who, of course, covers Amazon for us out of Seattle. So, Spencer, why isn't Amazon just giving up these numbers? Why not be more transparent here?
I mean, you have to think about the optics of such a thing. You know, big employers like Amazon and Walmart, just by the nature of their size, will have more cases. And so then if that becomes, there's got to be some headline risk associated with divulging that number, and then that making people potentially fearful of shopping in those stores or getting those packages delivered to their homes. So I imagine that's a big part of it, beyond them just saying that it's not really meaningful. But it is a difficult line to give, to say, oh, we know it, but don't worry about it. It doesn't mean much, you know, when it's really the fundamental question a lot of people are asking right now.
Well, and then I wonder, could Amazon indeed be forced to give up this number? And then how does that look?
Well, if they're forced to give up the number, I mean, the number will be revealing, obviously. I think Amazon's concern that people will fail to take the number in context. I think that, you know, regulators and lawmakers are a little smarter than that and will be able to see the number in context. So simply withholding it for that reason seems pretty flimsy. But I do think that, there's definitely fear. The businesses can be shut down. Governments can move in and shut things down. And generally it's based on information. It's based on data about how many people have been infected, how many people have died. So there's definitely this ongoing tension between how much businesses are willing to divulge and what lawmakers are demanding.
Now, what we know so far is fairly anecdotal. I mean, you've been reporting about an outbreak at a warehouse in Pennsylvania. There have been sort of leaked reports about, I believe, half a dozen Amazon workers who've died from COVID-19 across the country. I wonder, why isn't Jeff Bezos out front on this? We know that Dave Clark has been sort of the face of Amazon's response, but should Jeff Bezos be the one out there responding to these inquiries, and why isn't he the one out there?
Jeff Bezos has never really been one to jump in the line of fire. When he does appearances, he likes to talk about exploring space or, making deliveries by drone. His appearances are very carefully considered and choreographed, and it's not in his style to jump into the line of fire. So, yeah, it seems like Dave Clark has been tapped for that role right now. That could change because there are now these demands for Bezos to appear before antitrust committees looking into Amazon for other reasons beyond worker protection. But there's definitely more interest in him appearing and answering questions more so than he has done historically.
Right, and we are in an unprecedented time right now, and you are seeing other CEOs get out front. And that said, to be fair to Amazon, Walmart hasn't given these numbers up. There's been a huge outbreak in the U.S. meatpacking industry, so it's not as if Amazon is alone. What do we actually know, quickly, Spencer, about the numbers?
Well, they are saying that the numbers are not in any way higher than the surrounding communities. So that's the safety or the consolation Amazon is giving. But again, they're not giving the raw number so that people can double check that.
All right. Bloomberg Spencer Soper for us in Seattle. I know you'll continue to cover this story. Thank you so much for joining us. Coming up, we're going to be talking to the CEO of Eventbrite, Julia Hartz, a company that's had to lay off 45% of its employees. That's next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang. While live in-person events have ground to a halt, online experiences are booming. Eventbrite saw a 2,000% year-over-year increase in virtual events on its platform. This is a company that's also had to lay off 45% of its employees. Earlier, I spoke with Eventbrite CEO Julia Hartz about the trends and challenges she's seeing.
I would be lying if I said that the last 2 months haven't been extraordinarily difficult. So many businesses have been hit by COVID, and the live events industry is really one of the first hit and one of the most severely hit. So our focus has been around enabling our creators to continue running their businesses. Many people don't know that our creators are professional, they're small businesses, they're entrepreneurial. So as they're finding ways to connect with their communities, we're following behind and strengthening our platform and giving them an extended reach to new consumers. One of the interesting things about online events is that, without that barrier of geographic constraint, there's been some really interesting growth happening on the platform. And as far as in-person events, when it's safe to gather again, we will be there to help our creators rebuild their in-person live events. But honestly, it's not up to us to predict, it's up to us to prepare. And so that's what we're doing.
So you're seeing this 2,000% increase in online events, but how much can that make up for the decimation of in-person events?
Well, what's interesting is that we've seen about 10,000 frequent creators who were on the platform in 2019 publish online events in just April alone. And we transacted over 8 million free and paid tickets. So there's definitely a heartbeat there. There's a voracious appetite by consumers to want to connect around things that they care about, whether it's cooking or yoga or music. these are ways in which communities can come together and congregate and support one another. And so it's not so much about whether or not online events can save the live events industry. It's really about how communities can continue to have that connection until we can meet again in person.
And I know we're all desperate for those connections as we go, on into month 3 of this. You did lay off 45% of your staff. I know you took a pay cut. Shares have been down over 50% in the last 3 months. I imagine that this has been a gut-wrenching process for you. So, talk to me about how you see the recovery, or is this just a smaller, leaner business going forward?
Well, I think you hit the nail on the head when you said gut-wrenching, and I, the words that come to mind are heartbreaking. After building this business for 15 years with Kevin and Renaud and thousands of Brightlings around the world, it was really the last thing that I wanted to do to make that decision. But I think what people need to realize is that companies that can make thoughtful, swift decisions and take bold actions, even in the midst of an unthinkable crisis, are the ones that are going to endure in the future. And so for us, it was about hunkering down and honing in on a simplified strategic focus. And clearly for us, that's our self-sign-on business, which generates greater growth and higher profit as a channel, as well as our frequent creators, who internally we call super creators, because they really are superheroes. They're coming to Eventbrite to host many events, and we're seeing them continue that online. So we have every expectation that into the future, we'll be able to serve this segment of customers more efficiently and be able to grow our business faster. And that all culminates around this idea of us being leaner and stronger.
Now, I know you pulled your forecast for the year, but I know you're doing the modeling and the remodeling and trying to predict what's going to happen, even though there is so much uncertainty. What do you see in the second half of 2020, knowing that it might not be a V-shaped recovery and something much more abnormal?
Well, I'd go back to first the last 2 months and, our principle of being transparent and forthcoming with our shareholders. In early March, we started to see the impact of COVID, and that was a very, very quick deceleration in demand on our platform. Right after that, we started to see event cancellations and postponements start to rise. So we started to mobilize right away. And I think, suspending our business outlook was a way for us to signal that the impact was real and that it was direct. And then we went to work on helping our creators manage through this crisis, whether it was be able to, provide refunds in bulk or create in-kind donation opportunities for their fans and patrons to help support them, or launch crowdfunding campaigns for donations to help support the staff members. So as we look toward the second half of the year, I think you'll see more recovery efforts, more relief efforts. What's remarkable about Eventbrite's community is that it's really local, and so ticket buyers care a lot about these event creators and their local venues. So I think we'll continue to see that occur. And then, the recovery is not something that anyone can exactly predict. However, what we're planning for is to be able to continue to support our creators in online events, in recovery efforts, and also in creating more frequent, smaller events. And finally, when we think about safety, that's something that's going to be on the top of everyone's mind. I think that consumers will be the ones to dictate when events come back, and creators will be the one to match that voracious appetite with great content and deliver a safe experience.
Julia Hartz there, CEO of Eventbrite. Coming up, President Trump is weighing in on Elon Musk's decision to defy California authorities and reopen Tesla's production facility in Fremont. We'll discuss that coming up. This is Bloomberg. Elon Musk is thanking President Trump for endorsing his decision to reopen Tesla's manufacturing plant and defy county orders. This comes one day after Musk publicly acknowledged he's risking being arrested. I want to bring in Bloomberg's Ed Ludlow, who's been covering this story for us. And Ed, we've got the tweet from the president here. California should let Tesla and Elon Musk open the plant now. It can be done fast and safely. Musk tweeting back, "Thank you." What is the latest that we know? The factory is open, and I know you've been talking to workers.
Yeah, so they did restart production yesterday. Musk answered a tweet that asked how it went. He said it went great. And we've been speaking to workers who have turned up to the factory. They've been temperature checked using infrared temperature thermometers. They've been given PPE like masks. There is plexiglass to divide up and give space between break areas. There are plastic hanging sheets on the production lines to keep workers safe. And production is ongoing. We don't know kind of what level they're at. We don't know how the ramp is going. But by all accounts, Fremont is back up and running. They took that decision over the weekend, as you know. And basically, they gave workers little choice. You know, we saw an email from HR at Tesla over the weekend that said the furlough had been lifted and that workers were requested to come in, that they could stay at home if they wanted, but then they would risk going out without pay and benefits. So that's kind of where we are as of this moment.
Now, what are the legal issues here? We know that Tesla has sued the county officials. We know that the county has said that they are working with Tesla. And we also know that there are plenty of other businesses that would love to reopen if they could. Why should Tesla get a free pass?
So Tesla's complaint, or at least its legal filing that it made over the weekend, is that Alameda County's decision to not allow them to continue production, which they are anyway, frustrates due process, and that it goes against the state and the federal freedoms that were granted to Tesla as an essential business. And if you look at Elon's tweets over the last few days, he's been retweeting a lot of his supporters who say that the state of California allowed him to restart production. But that's not true. What happened on Friday is that California Governor Gavin Newsom allowed manufacturing to restart in some parts of the state, but he underlined that with the local authorities, including Alameda County, could continue to be more restrictive if they felt it was necessary. And he reiterated that line today. And the legal issue is that Alameda County has said that Tesla can only operate at a basic minimum operation. That basically means any workers that can work from home can, and that any activity at the factory itself can only be to basically maintain it, minimum activity. And that is the conflict that's going on here. And what a lot of the tweets suggest is that Elon is saying that he has permission from the state of California. But if you look at what Gavin Newsom has said, and you look at the written documents provided by Alameda County, that's not actually the case. And behind all of this, we know that Tesla is, while it's ignoring the order and it's carried on with production, it is actually in talks with Alameda County. We know that as of today, Tesla presented a kind of new back-to-work plan. They're in talks with the county officials about keeping workers safe. And Elon's basic argument is that if other manufacturers in the U.S. are allowed to reopen in other states and in the state of California, why should Tesla not be allowed to be? And he also kind of cites Tesla's experience in China, right? They had their Shanghai plant closed for a period of time because of the virus. They were able to reopen it successfully. And these are the two things that are kind of happening in parallel, and his two main arguments for getting Fremont back operational.
Meantime, you've got Dr. Anthony Fauci warning the country that reopening too soon could backfire. And there's no doubt there's tension here. There's a huge camp of people that want the economy to reopen. There's economic devastation across the country. And then there's also this public health crisis. Is there any chance that the county could or would actually arrest Elon Musk?
So the communication we've had from Alameda is that it would be up to Fremont Police Department to make that decision. It is not a decision for the state, and it's not a decision for Alameda County health officials. It would be for the Fremont Police to basically judge whether Elon Musk and Tesla are in contravention of the rules. But that, hasn't happened. And as I said, there are talks that are ongoing, and Alameda County officials have kind of shared some of the details of those talks with us. The analysts that I spoke to over the weekend and today, they just see this as posturing and brinkmanship by Elon Musk. He's taken on the law in the past, and he has been successful. And really, it just highlights, for me at least, how important that Fremont plant is, right? It's the heart and lungs of Tesla's global operation. They build more vehicles there than anywhere else. Yes, Shanghai is impressive, but it has a smaller output, and it's just for the domestic market. It's the only site where they build Model X, Model Y, and Model S, which are very important vehicles for Tesla's top and bottom line. And Elon Musk is basically prepared to take the risk, right? He wants to get his main manufacturing facility up and running.
Right.
Because don't forget, they had this blistering start to the year, a profit in the first quarter for the first time, ahead of schedule on Model Y, and that was all derailed by the virus. So I guess he's just doing whatever he can to get this company back on track.
All right, Bloomberg's Ed Ludlow, great reporting there. Thanks so much, Ed, for that update. Meantime, coming up, female founders are facing an even more challenging time getting money in the midst of this pandemic. We'll discuss coming up. This is Bloomberg. As cities and states across the country relax lockdown measures, Nasdaq CEO Adena Friedman talked about how the exchange is handling the pandemic earlier with Carlyle co-founder David Rubenstein on Leadership Live. Take a listen.
I think that there are two factors to consider. First, the composition of NASDAQ, the NASDAQ Composite Index and the NASDAQ 100 Index. If you look at the companies that choose to list on NASDAQ, we do have the companies that really are defining the economy of tomorrow. We do, of course, have companies from every sector listed on NASDAQ. But when you look at the companies that are doing well through this crisis, they do tend to be NASDAQ-listed companies, whether they're biotech companies. We have 94% of all biotech companies listed on NASDAQ, as well as technology companies. And those companies are demonstrating great resilience, which then, of course, drives the index values on the NASDAQ. I think the second key factor is the Fed. So the Federal Reserve in general, if you look at the overall performance of the markets, not just the companies listed on NASDAQ, but overall, I think the impact of the virus has been muted by the aggressive action of the Fed to support the economy, to support companies, to make sure that we have easy access to capital and that we can manage our companies through this crisis moment. We did a survey of every employee to ask them what is their comfort level to come back under certain conditions and based on the status of different cities where we operate. And we have some employees who are eager to come back, but the vast majority of the employees want to continue to wait and see how things progress in the cities where they operate before they come back. We have the luxury of patience. We have the ability to work from home very effectively. So we will ask people if they want to come back voluntarily and they feel they can do it in a safe way. Then we would like to start to reopen offices to give them that flexibility. But we then will put a whole lot of protocols in place inside the offices to make sure that they stay safe while they're there. But the fact is it will be voluntary only for the foreseeable future because we can work so effectively from home.
So let's talk about China for a moment. The U.S.-China relationship is a little complicated at times, maybe because of COVID-19. So are you taking companies public on NASDAQ that are Chinese-based? Is that a challenge now or not a challenge?
We are accepting listings from China. We always have. I think that both NASDAQ and New York have been an active market for companies from China. I do think that there are some challenges that the SEC has acknowledged that they are going to address through a roundtable. So we do have some very specific issues with the way that disclosures are provided and from certain emerging markets, including China. I think the SEC is working on that. They've acknowledged that they have an issue to work on, and we're excited to work with them, frankly, to find ways to improve that part of the Chinese listing experience. But generally, we continue to be an active listing exchange for Chinese companies, including a company called Kingsoft Cloud that went public last week.
So a lot of people in the business community have been lobbying Congress or the administration to get some support to help them. Have you been lobbying Congress or the administration on behalf of either your exchange or your members?
Well, we're in a very fortunate position where we don't have to lobby on our behalf. I think that, in fact, also the rules that govern the exchanges worked quite well through this crisis. So we haven't had to work very extensively with our regulators because the equities markets and the options markets have operated quite well through this whole crisis. But we do work with our listed companies to make sure that they're getting the support they need. And I'm a member of the BRT, the Business Roundtable. We are working very hard to make sure that we advocate for small businesses, to make sure they're getting the access to the capital they need. And then, of course, we can support the government as they're thinking through their programs. I have to say, I've been very impressed with the federal government, in terms of the fiscal support that they've been giving and how fast they moved, as well as the Fed. I think the Fed did some pretty extraordinary things early on so that they really staved off, they really did try to make sure that they staved off a deteriorating situation quite successfully.
Adena Freeman, CEO of Nasdaq there. Well, before the pandemic, women-led startups already had a tough time getting funding. Now it looks like in the middle of the pandemic, it's gotten even harder. The number of companies founded by women, funded by venture capitalists, dropped to just 4.3% in the first quarter of this year, down from an already low 7% in 2019. Joining us now, Erica Kramer, co-general partner of How Women Invest, which supports capital raising for women leaders. Erica, thank you so much for joining us. This is something that I've been thinking about because obviously we know that most of the companies that get funded are run by men, and you wonder if in times of crisis, investors will go back to what they know, the patterns that they feel like they can trust. And so I wonder what that has meant for female-led companies that are also trying to raise money in the midst of a crisis.
Well, thank you, Emily. I'm very happy to be on your show today. Yes, it does start with some negative news, as reported yesterday, that number of investments in female-founded companies has dropped. So women, and especially women of color, are disproportionately impacted for funding in this environment. 40% of companies in the United States are founded by women, yet only 2.7% of those companies actually receive venture capital funding, and that was before the pandemic. So we are quite concerned, and there's a fear that actions revert to old and familiar behaviors. This country can't afford to revert to unconscious bias where folks feel most comfortable. We have an opportunity to do things a little bit differently today, and so now it's the time to get out of the comfort zone. There's some interesting statistics here, but here's the real opportunity. Due to the lack of capital backing, women have been forced to be more capital efficient. Studies conducted by Kaufman Fellows and Boston Consulting Group, PitchBook, and Crunchbase have shown that for every dollar raised, women generate 78 cents in revenue versus 31 cents by men and achieve 35% plus return on investment. A successful recovery and return to growth in GDP are dependent upon the untapped leverage generated by female-founded companies that drive this economy. We have to think about the message that's being sent to female and minority clients, employees, and to our daughters. So I'm happy to describe how.
Thank you, Erica, Thank you for restating the statistics there. It never hurts to hear them over and over again. Your How Women Invest Fund, tell me what kind of companies run by women you're prioritizing, especially in this environment. I assume that you are seeing some new opportunities and creative ideas as some of these women founders are forced to get innovative.
Yes, absolutely. We have shifted our focus, and we are prioritizing those companies that will likely benefit from this environment. One company is in the healthcare sector. They're using data analytics to enable prediction of insurance reimbursements, detect fraud, and identify cost and risk. Another is another artificial intelligence food company in the food sector, and they're best at defining ingredients that should be used in foods that support health in a COVID environment. We're happy to say, even though we haven't gone to market really and letting the whole world know that we're investing in female-founded companies, that out of our network, we've been introduced to a number of female-founded, female-led companies in the U.S. that are tech-enabled, and over half of those companies are actually run by a woman of color.
All right, Erica Kramer of How Women Invest. I'm so glad you're out there doing this work and raising awareness about it. Thank you so much for joining us today on Bloomberg Technology. And that does it for this edition of the show. Stay tuned. Bloomberg Daybreak Australia is next. I'm Emily Chang. This is Bloomberg.